Hey guys, it's Charlie G. I hope you're all staying safe. I felt like being out today. I'm going to be covering why it's important to do a 30-year versus a 15-year because a lot of people don't understand the mechanisms of the difference. And although it sounds better, the 15-year, that you can cut your expenses in much quicker time, but not necessarily. So I'm going to break that down to you in today's video. If you looked at my other series where I always use the same scenario where you're a single person making $60K a year, you purchased a house and the house was $420,000. It was a multifamily, right? Your mortgage was $2,933 a month for the 30-year mortgage, right? How did we break that down? So let's look at it this way. Your down payment was 3.5%. So you were definitely doing an FHA loan. Your interest rate is at 4%. Property taxes is $6,000 a year, which is $500 a month. And lastly, your home insurance, your homeowner's insurance is $167 a month. If you add all that up, that's $2,933, right? We understand that part. So now let's look at the breakdown of the 15-year mortgage. Pretty much for the 15-year, your homeowner's insurance, your property taxes, they're not going to change. You're stuck with these things for the duration of the loan. The only thing that will change is your principal and interest. You will pay more in principal and interest because you're cutting down your time in half. So the home price still $420,000. My down payment still the same at $14,700. My private mortgage insurance is still $331. My homeowner's insurance is still $167. And my property taxes is still $500. The principal and interest, however, is $2,799. So all in total, your mortgage is $3,797. The interest you would pay over the course of the 30 years of the loan would be $290,000. For the 15-year option, you would be paying $98,000, so almost $100,000, right? So you are saving about $200,000, right? If you do the 15-year option. That's what you would think because that's how it's written for you. But what the bank is using, the more money you give them, they're putting it into different things. They're investing it and making your money flip 10 times. Not only that, they're also collecting interest from other people's mortgages using your money as well. So they're lending to other people. So why not be like the bank and also invest what you have instead of putting it into the home? Just take more time to pay them back and invest the money so that way you can have. And this is exactly why the 30-year is a better option. So here's the math on the better option of instead of taking that money and putting it towards your mortgage, you could put it elsewhere and allow it to grow. So here is the breakdown. If you go with the 30-year options, you're saving $864 a month, right? For those 15 years. So let's see how those 15 years are impacted. So if you take that $864 that you would be putting towards a home, towards a brokerage account where you are actually invested. It could be a mutual fund or you could even do stocks, but you have to be investing very conservatively and in a way that you're doing this for growth to beat and outpace that 7% rate as much as possible. So you could range anywhere from 7 to 10%. But the goal is for you to not do anything aggressive, but just to grow at a very conservative pace. If the investments don't grow, it will be $155,000, right? Over the course of 15 years. That $864,000 that you would be putting aside, and it would be growing at an average rate of, let's say, 7% a year, would actually be over $276,000 over the course of 15 years. So do the math right there, right? If you put that money towards the 15-year mortgage, right, to pay more to the bank, you are saving $190,000. But however, if you take the difference of that amount and invest that money instead, if we do the math, that's over $80,000. That is so much better. Why not have that money available to you? Because if you think about the home, for you to be able to get some of that cash, you have to either refinance or sell the house, right? You either have to refinance or sell the house. So it kind of doesn't make sense to do that. If you had investments growing at 10% a year, that amount will be $360,000. The whole point is instead of putting that amount of money into the home right away, use that money and invest it and let it be available to you in case emergency reasons or something happen. It's there and it grows at a much better rate as well. And there's so much you can do with that money as well. So let's take a look, right? Let's say now the homes appreciate over the course of the 15 years. So instead of your home being worth $420,000 in 15 years, it's now worth $560,000, right? The down payment on that home would be $112,000. If you are saving that $864, it would take you 8 years for you to buy another home and have 20% down for that home you're trying to purchase to save that $112,000. And that's with an annual return of the 7% that I explained. You can get there much faster if you're making 10% on your investment every single year. And this may not be for everyone, and I completely understand that. This is if you want to get a secondary home and be able to accelerate your whole rental real estate portfolio. It may not be for everybody, but it's another way to look at it where you can really grow the value of your rental, and it's an income that will follow you as long as you own a home. After you finish paying that mortgage, that income will stay with you. Rental prices will continue to go up. However, your mortgage stays the same for the amount of time. So after 10, 15 years, rental prices usually grow maybe 30%, I would say. It depends on where you're at, but it outpaces your mortgage rate because your mortgage stays the same. The only thing that increases is your property taxes. Your insurance may go up as well. But for the most part, your rental income would outpace your mortgage overall in total value. So it's very important. If it's something that you're comfortable with doing, go get that second home. And if you are getting a second home, it should not be costing you. It shouldn't be like your first home where you got the FHA loan, where you broke even. This home should be making you a surplus. So if your expenses, let's say, is $4,000 a month, that home should be bringing in $5,000. You should have $1,000 of surplus. Of course, you're going to have repair, but that home should be paying itself off completely. You're going to have to do repairs, etc., but that's why that extra surplus is there for. As I explained, it may be hard in the beginning, but owning a home is a great and beautiful thing. So before you go and try to do 10-year or 15-year loans, stretch that loan out as much as possible, because the longer you take to give the money back to the bank, of course, you're going to be paying more interest. But if you take that same amount of money and invest it on yourself and other things as well, you're going to grow that money much better than they would, because they're amplifying whatever you give them a lot by like 10 times. They're lending it to other people who's paying them same thing, like 2-3 times the amount. And they're also investing in different things, the market, bonds, stocks, whatever they can get their hands into. So why not take part in terms of what they're doing as well? Let that benefit you. So it's very important that we don't just blindly go and take that 15-year and just sign up for it. So look into the 30-year, because it's always a better option than the 15-year. I hope this helped you, whether you're making that decision. Again, this is just my own advice. Whether you go with the 15 or 30 years, it's totally up to you. Some people prefer to get it out the way and not have to deal with that and do the risky investment. But it is totally up to you. This is just explaining the breakdown and the differences between the two. I'm not telling you exactly what you need to do. You have to make that decision for yourself. Please subscribe if you haven't done so already. Drop a comment if you can. Let me know your thoughts and anything else you'd like to discuss. Stay safe and peace.